Dear students, welcome to the revision session for this exciting exam, the financial reporting. I call it exciting because this exam is very interesting and it gives you the concepts and the areas which are very practical. And if you're working anywhere, you will see these concepts in practice. Okay. The first the first topic that we have picked up to attack is the IAS 36. And we are going to start the questions. As I said, that some of these questions are from BPP, some of them are from Kaplan, some of them are from the ACCA Hub. All the sources have questions of various difficulty levels. So I have tried to pick up the questions which were most challenging one. So it's a good mix for your practice. Okay. So fine. Okay. So here we go. The first question that we have for IAS 36, let's read and understand. Okay. So the question is to the nearest thousand, what is the balance on the building following the impairment review? So there is some impairment review being taken on, and there are various assets, and we have to look at what is going to be the balance after the impairment review for building. So we have this a division of an entity has the following balances in its financial statements. They have various assets, like they have goodwill worth 700,000. They have plant 950,000. They have building 2.3 million. They have intangibles 800,000. They have other net assets 4,30,000. Following a period of losses, the recoverable amount of the division is deemed to be 4 million. So we need to find out the value of all these assets in this unit, and then we're going to see that the recoverable amount is 4 million. So if the value of this division is higher than 4 million, then clearly the impairment has taken place, and then we need to charge the impairment. Okay. So let's see. A recent valuation of the building showed that the building has a market value of 2.5 million. So we see that the building here has a value of 2.3 million, but they say that the recent valuation of the building showed that the building has a market value of 2.5 million. Overall, there have been losses, but building has increased its value. It is at 2.5 million. The other net assets are at their recoverable amount. So the other net assets are there at their recoverable amount. They have actually reduced in amount, since they say that the recoverable amount of overall division has become 4 million. The entity uses the cost model. Since the entity uses the cost model for valuing building and plant, so we won't be revaluing it. Okay. So we are going to keep it at whatever value it is reported. Okay. So just to see whether the impairment has taken place or not, we will just calculate the values. However, for the building, we're not going to charge any impairment to the building. Okay. Because whenever we're dealing with impairment, we see that there are indicators of impairment. So when it comes to building, there is no indicator. Instead, there is indication that the building has increased in value. However, we cannot incorporate the value because the entity is using the cost model for valuing building and plant. So there is no indication that the building has lost any value. Okay. So we will be calculating the impairment, how much impairment has taken place. But when it comes to the value of building, we are not going to charge any impairment to building. Okay. So what is the balance on the building following the impairment review? It is the same value which is already kept in the financial statements. Okay. So the answer to this question is 2.3 million. Okay. There is no change in the value of building. It has only increased in value, and there is no chance that it will be losing any value. Okay. We cannot incorporate the market value since we are following the cost model. So I hope this is clear. We do not need to get into any working. We say that the building has not changed in value. Fine. I hope you understand this part. Yeah, some feedback would help me understand. Otherwise, I will just move on if no one is raising any point or raising any question. Okay. So I've got a few.
Before you continue, I have a question.
Yes, please.
Yes. I wanted to know if we were given these questions prior to the meeting.
Yes, yeah, now it's late. For the upcoming session, we will be providing you the questions. Okay.
All right, thank you.
You're welcome. Okay. Yes, yes, there is this question that if it is the fair value, that is the market value. So the market value is 2.5 million, but we cannot use the market value because the entity uses the cost model. That's why we are keeping the value at 2.3 million. Since we are looking at impairment, there are always indicators of impairment. So in this particular case, there is no indication that the building has lost any value. Instead, the building has actually increased in value, but we cannot incorporate the higher value. So I hope this is clear now. Okay. So moving on to the next question, the same data will be used in the next question. And then we have the other calculation, because in the next question, another asset, the value of another asset is required. So let's see what is the challenge ahead. So we will have a chance to calculate the impairment, and we will have a chance to charge this impairment. Okay, so let's clear the drawings here. Okay, so now looking at the data, it's the same data, but the requirement is different here in this case. Okay, so let's see. We are now going to look at this one.
I know you.
Let's see.
I know you.
Students, kindly mute yourself. You can unmute when you want to ask questions. Okay. So to the nearest thousand, what is the balance on plant following the impairment review? So now it's the same situation, same values, goodwill, and all these assets. This is the value of the whole division, and the recoverable amount is 4 million, and same, the building has this increased in value. A recent valuation told us that the building is worth 2.5 million. So it's the same information as question 1. Okay, but the change is that in question 2 we are required to calculate the value of plant. Okay, so now we first of all need to calculate the value of the carrying amount of the division before the impairment, and then we're going to compare it with the recoverable amount to calculate how much impairment has taken place. Okay, so let's see. We have this the carrying amount of the division. So it is 700,000 plus 950 plus 2300 plus the 800 and plus the 430. So this gives us the carrying amount. So let's calculate these values here. 700 plus 950 plus 2300 plus 800 plus 430. So the value of the whole division is 5.18 million. However, the recoverable amount is 4 million here. Okay, so let's see, let's compare it. So we say that if the recoverable amount is 4 million, so we can say that the impairment has taken place. The impairment is the difference of these two, that is 1180. Okay, so this is impairment. Now this impairment needs to be charged, and we're going to pick the assets on which we're going to charge the impairment. So according to IAS 36, the goodwill will take the maximum load of the impairment, like the goodwill will be totally gone. So first we're going to allocate or charge the impairment to goodwill. Then we have the plant, building, and intangibles. the net assets do not take any load of impairment according to the standard. So we are left with the plant building. And we have already discussed that the building has not given any indication of losing any value. So no charge to the building, no impairment charge to the building. So the two assets which are left are 950, that is plant, and the intangibles 800. Okay. So these three assets will be charged with impairment. Goodwill will be totally consumed with impairment loss, and then we are going to, whatever loss is left will be divided between plant and intangibles. Since we're only trying to calculate the value of plant, so we will calculate the impairment charge for plant. Okay. So I hope you understand. I will now proceed with the workings so that the total impairment, we've already calculated it, which is 1180, and we have we're going to charge it to goodwill. All the goodwill will be consumed here, so we will say that 700 is gone. The value of the goodwill is 700,000. So we are using all figures in thousands so that there is no confusion. So okay, so goodwill takes the load, and after that we have the impairment that has still to be charged is 480. Now, since we have to calculate the value for plant, the charge to the plant is we take the value of goodwill, which is 480, which is left, the value of impairment rather, multiply with the value of plant, divide by the total value of plant and intangibles. So that is 950, the value of plant, plus the value of intangibles is it is 800. Okay. So with this, we will calculate the charge of impairment for plant. Okay. So let's calculate the value here so that we can see. Okay, so here we go. So let's sum up the value 950 and 800. That sums up to 1750. So now we can do the calculation. So 480 multiply the value of plant, divide by 1750. So the answer that we get, the charge for the plant is 261. So let's write 261 here. And then we calculate the value of plant after impairment is going to be this 950,000 less 261. So we will have the answer. Let's see, 951 minus 261. So that is 690. So the answer here, there are already zeros placed here. So we're just writing 690. Okay. So that is the correct answer. I hope this is clear. We got to know how to calculate the charge of impairment for a specific asset. We followed the procedure, like the goodwill takes the goodwill is totally consumed by the impairment, and then the remaining of the impairment loss was shared between plant and intangibles, since building hasn't given any indication of losing any value. Okay. So I hope this question is clear. They use the same data for two questions. Okay. So I hope you're comfortable with this one.
Yes, sir. Thank
Yes.
you.
Yes, sir. It's okay.
Yes, sir. Thank you, sir.
Okay, excellent, excellent. So we 950 less 261. So if it is, it is 689. Because we were required to calculate the value of, there is a question. We were required to calculate the value of plant. So the value of plant is 950,000, and we're not trying to calculate the remaining charge. We're trying to calculate the value of plant. So we calculated how much of the impairment will be charged to plant. That is 261. The value of that's good. Okay. I'm already looking at your messages. So the student responded, it's okay. So we can move on. Yeah, you can always ask your questions. I'm looking at the messages continuously. Fine. So this one is done. Let's clear the drawings and we move on. Okay. Fine. Yeah, it's fine. Yeah, actually, I've rounded
Just a
figures. So
quick
you can do
question.
it. 680.
Sorry,
That's correct. Fine. 950
just a
minus
quick
260.
question.
This is Excel giving me the answers. Okay. Fine. Okay, so quickly moving on to the next question so that we could utilize the time properly. Okay, we have this. Let's clear the drawings. Okay, this next question is similar. I have picked up at least two similar questions so that you could reinforce the concept. Again, there are these. What would be the value of Fingal's property, plant, and equipment after the allocation of the impairment loss? So we have this. We have to calculate the total impairment loss, and then we are going to see how much of it can be allocated to property, plant, and equipment. So let's see the question now. The net assets of Fingal, a cash generating unit, are it has property, plant, and equipment 200,000, which is being asked in the question. We have to calculate the value for this one. Right now, it has a value of 200,000. The goodwill is 50,000. The product patent is 20,000. And the net current assets have a value of 30,000. The net current assets do not take any load of the impairment charge. So we can just put across here. So the overall value is 300,000. But as a result of adverse publicity, Fingal has recoverable amount of only 200,000. So there is an impairment of 100,000. And we know that goodwill consumes, like the whole of the goodwill is consumed with the impairment. So first of all, let's calculate the total impairment and then we can move on. So the total impairment is 300,000 is the carrying amount less the recoverable amount, which is 200,000. So we can arrive at the figure of 100,000. That is the total impairment. Okay. So that has been, this will be taken over by like the goodwill. So less the goodwill because the goodwill is totally consumed. Okay. So that value is 100,000, the impairment, and then goodwill takes over 50,000. So 50,000 of the impairment is left. Okay. The impairment left after goodwill is 50,000. Okay. So now this 50,000 has to be shared between property, plant, and equipment and product patent. You see, the goodwill is consumed. This is not available anymore. We cannot charge any of the impairment to the net current assets according to the IAS 36. So we're left with these two assets, the value of PPE, property, plant, and equipment, and the product patent. So the total value of these two is 220,000. However, we're only required to calculate the value of property, plant, and equipment. So let's see how we can figure that out. So the impairment charge for PPE would be 50,000 multiplied by the value of the property, plant, and equipment is 200,000 multiplied by or divide by rather, because we've got 200,000, divide by 220, because 220 is the sum of the property, plant, and equipment and the product patent. Okay, so let's calculate how much of the charge will be placed on PPE. Okay, I've got a message here. Let me just check. Okay, some students have already calculated the answer. Let me just get done with it and then I will check your answer. So here we go, 50,000 into 200 divided by 220. That gives me 45,455. I can now calculate the value of PPE after impairment would be, it is 200,000 less the 45,455. So we can now get the answer here. So 200,000 minus 45,455. So the answer is 154,545. Okay, so this is this was a good question to reinforce your concept that you have gained from the second question. Okay, so we will not be looking at a similar question. We'll be moving towards new questions. So I hope this is clear. Now this must have become easier as we have done another question on the same style. So yes, I hope we can proceed now. Okay, so that's good. So next one is a theoretical question. Let's attack it. So let's clear the drawings first. Okay, so which of the following is not an indicator of impairment under IAS 36 impairment of assets? So whenever we are trying to calculate impairment, we have to see indicators, okay? Some indicators are internal, some indicators are external. However, this question is not asking to figure out which are internal or external. This is just asking which is not an indicator. So we are provided with 4 options. We can see that 3 options will be indicators of impairment. Only one of them is not going to be an indicator. Okay, so let's see. Okay, I've got a message here. The goodwill is gone. The goodwill, okay, there's this question for the previous question. The goodwill has been consumed. The total impairment was calculated as 100,000, and the goodwill, we use the total goodwill, which was 50,000, and we consumed it with impairment loss. Okay, so the total impairment loss was 100,000 less we deducted the value of goodwill. Now goodwill is not there, and the impairment loss that is left is 50,000. So that 50,000 will be shared between PPE and the product patent. Okay, I hope now it is clear. Very good. Okay, fine. I've got another message. Okay, it says current assets not. Yes, the net current assets or the current assets, yeah, they are the same. So the net current assets do not take any charge of impairment. This is according to IAS 36, the guidance that the standard provides us. We do not charge any of the impairment to the net current assets. Okay. Because yeah. So fine. So we are now looking at this theoretical question. Okay, so let's see. So we have already had a discussion on the requirement that we are looking at indicators of impairment. And since the question wants us to find something which is not an indicator, so we can expect that 3 of the options would be indicators, and one of them is not going to be an indicator. So let's see the first one. Advances in technological environment in which an asset is employed have an adverse impact on its future use. So clearly, when due to new technology, the assets have become obsolete, have become outdated. So this clearly shows that the value of the asset has reduced. Okay, and we cannot use them in future because the technology is obsolete. We might have to buy a new asset. Okay, or the value of the asset has reduced. So this clearly shows that it is an indicator of impairment. Moving on to the next one, an increase in the interest rate, which increases the discount rates an entity uses. So the recoverable amount is the higher of value in use and fair value less cost to sell. So when the interest rates increase, we have to discount more, and that is going to lead to a lesser value in use. Okay, so a rise in discount rate would suggest that there is impairment. Okay, because the interest rates have increased, and that have caused the discounting to be more extensive. Okay, this increases the discount rate. So this is actually related to value in use, one of the elements of the recoverable amount. Okay, so I hope this is clear. The first 2 are actually indicating that there has been impairment or assets have lost their value. Okay, let's look at the third one. the carrying amount of the entity's net assets exceed the number of equity shares in issue multiplied by the share price. So this the number of equity shares multiplied by the share price tells us the market capitalization of the business, okay, or the value of the business. So they say that the assets that we have a higher value. The assets exceed the value of the net assets exceed the market capitalization of this business. So this clearly shows that the value of the business is less, and the assets that we have kept in the at the carrying amount in the statement of financial position have a higher value, clearly indicating that there's an impairment of the assets. Okay, so the first three are indicating impairment. Clearly, the last one is going to be the answer. Let's look at this thing. The external market of a new unit of an asset owned by an entity has increased due to uncertain supply. Okay, so we have this supply issue, and the demand of the asset has increased. Okay, so there is this asset, they've just mentioned a unit, an item that the entity has increased its value because of the uncertain supply. If you want a new item, it's not available. Okay, the supply is not there. So obviously, the people who have that item, they have more value of that item because the new item is not available. So clearly, this shows that the assets have increased their value. So this is not an indicator of impairment. So this is what we were looking for. So the correct answer is option D here. Okay, that clearly shows that no impairment has taken place because the value of the assets have increased due to the uncertainty of the supply. Okay, so I hope this is clear. We have looked at a theoretical question as well. Okay. Okay, let's look at option C again. Okay, so you see the value of the entity is how many shares they have issued, like they have the number of equity shares that they have issued, and we multiply them with the share price to calculate the market capitalization. So they say that the value of net assets is higher. Higher than what? Higher than the market capitalization, which is the shares multiplied by, or we can call it the number of shares multiplied by the share price. So the value of the business, which is the market capitalization, is less, whereas the assets have a higher value. So clearly, this indicates that the value of the assets is overstated, and we need to bring it down. Okay, so this is an indication of impairment. Obviously, we are not going to calculate the impairment based on the market capitalization. We're going to calculate the recoverable amount of those assets. We are going to find the value in use. We're going to find the fair value less cost to sell, and we're going to determine the recoverable amount. We're going to compare them with the value of the assets because there has been an indication. There might be no impairment. Okay, but since there is an indication, we need to carry out the review. Okay, excellent. Fine. So I hope this is clear. There is no confusion now. Fine. So I am moving on to the next one here. This is a numerical question that we're dealing with now. Okay. So let's see the situation. What amount would be charged to profit and loss for impairment of this asset for the year ended 30th of September 20Y4? So we have to find the value that will be charging to profit or loss for the impairment. Okay, so let's see what is the issue here. Relay acquired a non-current asset on 1st of October 20X9 at a cost of 100,000, which had a useful life of 10 years. So they bought this asset. Like, you need to remember that what is the year in question? It is 30th of September 20Y4. However, the asset was bought 5 years ago, that is October 20X9. So we're going to calculate the number of years and I will explain. So the cost of the asset is 100,000. The useful life is 10 years. and it has a nil residual value. So this is the information about the cost of the asset. The asset had been correctly depreciated up to 30th of September 2024. So they have calculated the depreciation, they have used the asset, and they have depreciated it, and now they have a carrying amount. So we're going to calculate the carrying amount, and now the information that relates is related to the recoverable amount. At that date, the asset was damaged and an impairment review was performed. And on 30th of September 2024, the fair value of the asset less cost to sell was 30,000. Now, this is the information about the recoverable amount. And the expected future cash flows were 8,500 per annum for the next 5 years. So we are provided with the cash flows. So we're going to use these cash flows. We're going to multiply these two discount factors to calculate the present value, which is going to be regarded as the value in use. So this is a really good question to understand the whole process of calculating the recoverable amount, okay? And the current cost of capital is 10%, and the 5-year annuity. So they have given us the annuity factor because the cash flows are uniform. Every year, we expect to have 8,500 from the use of assets. So that's why they have provided us the annuity factor, which is 3.79. So we're going to take the cash flows of 8,500 multiplied by 3.79. We're going to have the present value, which is going to be the value in use. Okay, so first of all, let's get done with the carrying amount, and then we can see. Okay, so the asset has been used for 5 years. So let's calculate the depreciation for the 5 years. So it has a 10-year life. So we can have this cost divide by your useful life, which is 10 years. So we will have this 100,000 divided by 10 years. This is going to give us the depreciation charge of 10,000. The depreciation for 5 years is 10,000 into 5. That gives us 50,000. We are going to have the carrying amount. The carrying amount of the non-current asset is 100,000 less 50,000 is equal to 50,000. So we now have one of the value that is the carrying, amount, which is 50,000. And now we're going to have the recoverable amount. The recoverable amount is the higher of value in use and the fair value less cost to sell. So fair value less cost to sell is provided to us, which is 30,000. Fair value less cost to sell is 30,000, and the value in use is 8,500. That is the annual cash flow. We multiply this to the annuity factor, which is provided to us as 3.79. So we will have value in use. So let's calculate 8,500 into 3.79. The answer is 32,215. So the recoverable amount is the higher of the value in use and fair value less cost to sell. So we're going to consider this, the recoverable amount is the higher value, okay? This being the higher of the two. So this is the recoverable amount. Now, we have to compare this with the carrying amount. The carrying amount is 50,000, which is above the recoverable amount. So clearly, the impairment has taken place. So we're going to calculate the impairment here. The impairment is 50,000, the carrying amount less the recoverable amount, which is 32,215. So we're going to calculate the value here. 50,000 less 32,215. Okay. Okay, someone has provided with me with the totals. Let's see. Okay, the answer. Yeah, the recordings will be available. No, don't worry. The recordings will be available. The session is already being recorded, and I will be providing you with the recordings. Okay, fine. So we have this 17,785. This is the impairment that will be charged to the profit or loss. Okay, 17,785. So I hope this is clear. This was a really good question because it helped us understand the whole process. We calculated the value in use, and we also calculated the carrying amount. We figured out that the carrying amount is higher than the higher of the two, fair value less cost to sell and value in use. So, and we calculated the impairment. So it's a really good question to have a good understanding of how to calculate the impairment. Okay. So I hope you're comfortable with this one. We can move on to the next one. If there is.
Sir,
Yes.
Sir, before we move on, sorry, Kana, it says that I understand everything, but I just have a question. Why is it that when it says it's the cash flow per annum, we don't take 5 years, we just take 1 year?
No, we're not taking 1 year. If you look at the discount factors based on 10%, so we have just added them up. Okay. If you just look at the discount the table, the discount factor table for 10%, and you add up all for the year 1, for year 2, year 3, year 4, and year 5, you add them up, the sum of those discount factors is going to be 3.79. So when we sum up these things, this is regarded as annuity factor. This is only done when the cash flows are uniform. Same amount is being spent, or the same amount is expected every year. If this amount was to change, then we cannot use this annuity factor. Okay. So this is just a shortcut. This is the same. If you take the discount factors at 10% for 5 years, you do separately, you will arrive at the same value of 32,215. Okay. So this is just to speed up the process.
Okay.
Fine.
Okay.
Okay. Very good. So let me just clear the drawings before we move on to the next question. Okay. So we have another question, which is again there to explain the basic idea. I have added these two questions so that we could reinforce the concept, the whole idea. So let's see. At what value should the plant appear in metrics statement of financial position as at 31st of March 20x4? So we have to find the value of the plant, okay, at 31st of March 20x4. So let's see. Metric owns an item of plant which has a carrying amount of 248,000 at 1st of April 20x3. So we are looking at the value at 31st of March 20x4. So clearly we will have to have depreciation for 1 year to calculate the carrying amount. We have the opening carrying amount available. It is being depreciated at 12.5% per annum on reducing balance basis. So they have also provided us the depreciation method. So we're just going to charge the depreciation, and we're going to have the carrying amount. So this is done with the carrying amount. Now the information is going to be for the calculation of the recoverable amount. The plant is used to manufacture a specific product which has been suffering a slow decline in sales. So this product is slowly declining. So Metric has estimated that the plant will be retired from use on 31st of March 2027. Like this plant will not be useful, and it will have to be retired by 31st of March 2027. The estimated net cash flows from the use of plant and their present values are, so these are the cash flows and these are their present values. So in this case, now we do not have to multiply them to the discount factors. We have already provided with the present values. So the sum of the present values, the net present value is 214,600. So this is one of the factors of the recoverable amount. And the other one is on 1st of April 20x4, that is the same date as 31st of March, because this is just the next day. On 1st of April 20x4, Metric had an offer from a rival to purchase the plant for 200,000. So this is the fair value less cost to sell. So we take these two values for the recoverable amount. And since the value in use is higher, we are going to take this as the recoverable amount. So we have the recoverable amount as 214,600, and we only need to find out the carrying amount. Okay. And if the carrying amount is higher than the recoverable amount, then clearly there is impairment, and we're going to charge the impairment. But the question is only asking what value of plant would appear in the statement of financial position. So let's see, we haven't calculated the carrying amount. So the carrying amount would be 248,000. That is the carrying amount for the previous year, multiplied by 87.5%, because the depreciation is 12.5. So if we take away the 12.5%, we're left with 87.5. So if we take the 87.5%, we could come up to the value, the carrying amount. Okay. So 248,000 into 87.5, that is 217. Okay. So this is not a complicated thing that I've done. I've just done a shortcut here, that if the depreciation is 12.5%, so clearly what is left after depreciation is 87.5%. Okay. So the carrying amount is 217,000. The recoverable amount is being the higher of the value in use and the fair value less cost to sell, which is 214,600. So clearly the recoverable amount is less, the carrying amount is higher, and we can say that the impairment has taken place. So we can calculate the impairment, but the answer to the question is 214,600. Okay, that is the answer, because this is the value that we are now going to keep in the statement of financial position. Okay. So, however, we can just calculate the impairment as well to be charged in the profit and loss. However, this is not required. We just compare these two values and we get the answer here. Fine. So this is 2,400. Okay. If this was required, but this is not required. We are only required what value should be reported in the statement of profit and loss. So I hope we are comfortable with this one. No issues with that. So students, I would just like to do one more question. There's another issue that we need to address before we could conclude this session. Okay, because I was about to conclude it, but there is this one question which I want to do with you.
No, sir.
Yes.
Question 29. The cash flow is given year to 31st March up to 20X7.
Yeah, it is
And the
available
report-
for.
And the
Okay.
reporting
You see-
date is...
Yes. I understand your question. I would like to tell you the value in use is the present value of the future cash flows. So the future cash flows expected from this asset are these. When we multiply them to the discount factor, we have the present value. So when we sum up all the present values, this is the present values of the future cash flows. That is value.
All right, I get it. Thank you.
You're welcome. Okay, fine. So I hope this is clear. We can move on to the next question. This is one issue which is new. I would have concluded the session, but I want to do this one specific question. Now, this question is from the ACCA Hub. So it's a good question. It's a different question. That's why I want to deal with it here. Okay, so fine. This is a question in which we have an asset which has been revalued. Okay, and now it is impaired. So now the question is, how much of the impairment will be charged to P&L, and how much of the impairment will be charged to the other comprehensive income? So this is what we have to do. Let's see. So let's understand this one before we move on. Okay, so you will understand once we are done with this. So match the amounts to indicate how the impairment loss should be accounted for in the statement of profit and loss. So we're looking at the impairment loss and we're going to see how much will go to the P&L and how much we are going to charge to the other comprehensive income in accordance with IAS 36. So Doji has a property which is currently stated at a revalued carrying amount. Okay, so whatever is revalued, when the revalued amount comes down to the carrying amount of the asset, if no revaluation had taken place, that portion of the impairment goes to the other comprehensive income. Okay, So due to a slump in the property prices, the market value of the property is currently only 180,000. So now if we had an asset valued at 253,000, the new value is 180,000. So clearly the impairment has taken place. The historical cost carrying amount of the property is 207,000, which means that if we had not revalued the item, the item would have a value of 207,000. So what is the value that is kept in the revaluation surplus? Okay, so that portion of the impairment goes to the other comprehensive income, and the other part which is below this value goes to the profit and loss. Okay, so when I'll do the math, you will understand it. Okay, so let's get on with it. So first of all, we're going to have the total impairment. The total impairment would be the revalued carrying amount, which is 253,000, and we have the less the market value. The market value is only 180,000. So we take that away and we get to the impairment, like how much of the impairment has taken place. That is 73,000. So the total impairment is 73,000. Now, how much of this will go to the other comprehensive income? Okay, so charged to OCI would be the portion that is related to revaluation. Okay, so the revalued carrying amount, similar, we're going to write 253,000 here, and we're going to compare this with the less the carrying amount if no revaluation. If there was no revaluation, then the carrying amount would have been 207,000. Okay, so now the difference of these two values will be charged to the OCI. So let's see, I could just write it 207. I could deduct 207,000 here, and we would have this value. So out of the total impairment, 46,000 would go to the OCI. Okay, so we could just say that this portion of the impairment would be charged to the OCI, and the remaining one would be charged to the profit and loss. Okay, so we could just see what would be charged to profit or loss would be the total impairment, which is 73,000, less the portion that has been charged to the OCI. So we're going to have this one charged to the profit and loss. 73,000 less 46,000, so 27,000. So this total impairment is 73, and out of this 73, the 46 is charged to OCI, and the remaining of this 73 is being charged to the P&L. Okay, so I hope this portion is clear. I wanted to discuss this question. I have 3 more questions similar to this one, so I will be sharing this document with you, and you people can attempt those questions. Okay, so I hope this concept is clear. You can be tested on this basis. Yes. Yes, people, I hope you are comfortable with this one. If I just scroll down in the
Yeah,
top.
very well.
Excellent, excellent. So we are now moving towards the next one. These are the questions, a similar question, not it's not difficult. These 2 questions are based on that, like how much would be charged to the P&L and how much would be charged to the other comprehensive income. Similarly, here they're only asking how much would be charged to the other comprehensive income. So to just reinforce your concept, you could attempt those questions. Okay, so we are going to take a short break of 10 minutes. According to my time, I have, this is 9:56. So we will be starting in 10 minutes. So you people should not leave the meeting, just keep with me, and after the break, we're going to continue. So I'm going to pause the recording here, and I will be starting with the next standard, which is IAS 12, taxation. Okay. Okay. Exactly. Yes, that's why we have to charge. Whatever is reversal would go to the OCI. You're right. Is it clear? Yes, students. Excellent, excellent. So, yeah, so no need to leave the meeting. Stay connected, and we will be starting in 10 minutes. Okay. So I will just pause the meeting, and we will start from here. Fine. We're going to attack the IAS 12 after this one. Dear students, we are going to continue with IAS 12, the taxation standard, which also causes a lot of problem for students. So I have selected again the questions from BPP and ACCA. And these questions are good ones to develop a decent understanding of the questions. I have tried to join similar questions that can help you understand the concept. So let's see, let's attack this first one. And as we progress, we will be able to understand this important standard in a really good way. Okay, so let's see the first question that we have. Okay, what is the amount of income tax recognized in the statement of profit or loss of Ulington Co. for the year? You need to understand that whenever the question is talking about the charge to the profit or loss, this will always have three steps. One of the step or two steps are easy, and the third step is related to deferred tax impact. Okay, so this question is talking about the charge, the amount of income tax that will be recognized in the statement of profit or loss. Okay, so let's see. I will just outline the answer so that whenever you're dealing with such a question, it becomes easy for you. Okay, so the current year tax charge, that is going to be one part. Okay, that's the first one. The second one is the under or over provision. The under provision will be added, and the over provision would be deducted. Over provision, like last year we over provided, so that would be adjusted here. And under provision, last year we provided less, so we're going to charge extra this year. And the third one is the deferred tax. The deferred tax charge or credit. So the credit would be a deduction. So we're going to work it out, and I will explain what is a credit and what is a charge. Okay, so let's see. So now you have this outline. Whenever you have this the question relating to what should be the charge to the profit or loss, it will always have three things. So when we look at this question, it will become very easy then. So Ulington Co.'s trial balance shows a debit balance of 2.1 million brought forward on current tax. So whenever it is talking about current tax, it always refers to the under or over provision. So how to decide whether it is over provision or it's under provision? Whenever you see a debit balance, at times the question is going to give you information whether it's under or over, but usually they say that it's a debit balance or a credit balance. So whenever it's a debit balance, this refers to under provision. Okay, and if it's a credit balance, this refers to over provision. So here we go. In this one, we are provided that there is this under provision. Like last year we provided less, so we are going to compensate for it, and we're going to charge extra this time. Okay, so this is related to previous year's charge since we provided less. So this is going to be 2.1 million here. These figures are rounded, so I'm just going to unround these so that you people can understand. Okay, just a second. Okay, so this is the rounding. It should be to 2 decimal places. So this is 2.1 million, and we could just write it here in millions. So I have just recorded the under provision, as I told you that it will always be an opening balance. And then we proceed with the next one, where we have this and a credit balance of 5.4 million. Okay, so this is related to deferred tax. So this means that the opening deferred tax is 5.4 million brought forward on deferred tax. The tax charge for the current year is estimated at 16.2 million. So they have provided us with the opening deferred tax, and they have provided us with what is the charge for the year. So I told you that there are going to be some easy points here. So one thing that you need to determine what is under or over. I told you how to do that. So this part is done. This is also considered easy, and the easiest is the current tax charge. The question will always provide you with this figure. So like this, in this question, it is 6.2 million. So we can just simply write it here that the charge for the current year is 16.2 million. So no problems with that. The issue is with the deferred tax. So for this, we can have this working. We could say that this is the working. This figure will be coming from the working. So let's do a small working here for the deferred tax. So deferred tax working. So as the question has provided with the opening deferred tax, the opening deferred tax figure that they have provided to us is 5.4 million. Okay, so again, we will have to unround these figures, and we will also provided with a closing figure. Okay, let's see. I will correct this figure. Let me just do it right here. Actually, I've rounded these figures, so this is 5.4 million. So now if we go back, this is the opening figure. The current amount of net assets are 13 million in excess of the tax base. So when there is this, the value, the current, the carrying amount of the assets is more than its tax base, then this refers to a temporary difference. And when we apply the tax rate, we calculate the deferred tax liability. Okay, when usually this happens, the carrying amount is higher as compared to the tax base. So here they say that the carrying amount of the net assets are 13 million in excess of the tax base. This is what normally happens, because the tax authorities are generous in giving the capital allowances. Okay, so tax base is usually low. If this is high, then we have a deferred tax asset, but in this case it is low. And at the start we also had the opening deferred tax liability, so closing will also be a deferred tax liability. But there is one more twist here, which includes 3 million revaluation surplus on the first revaluation of buildings. Okay, so this is related to revaluation. Now, revaluation of the building is a gain which is unrealized. Okay, so we are trying to calculate the charge for the statement of profit and loss. So we are not going to charge something which is not realized. So the overall increase in the or overall difference between the carrying amount and the tax base is 13 million. Out of that, 3 million relates to revaluation. So we will only consider the 10 million, the difference of 13 million and 3 million. And we're going to calculate, and we're going to apply the tax rate on that figure to calculate the closing deferred tax liability. Okay. Why am I doing this? Because the 3 million relates to revaluation, which is the unrealized gain. Okay, so let's do this thing. This is the opening deferred tax liability, and now we're going to find the closing. This is the opening deferred tax liability, and the closing deferred tax liability is 10 million, which is 13 minus 3 multiplied by 30%. So that will be 3. So the deferred tax liability has gone down, which means that it's a credit. Okay, if the deferred tax liability had increased, it would have been a charge. But since it has gone down, so it's a credit. Okay, so we can say the deferred tax credit will take place here, and the value is going to be, we take the difference of these two. So that is 2.4. So the credit is deducted as I showed you initially here, 2.4. Okay. So now we can sum up these figures to calculate the charge to profit and loss. So the answer is 15.9 million. Okay. So you can see that the under over provision and the current year tax charge was straightforward. In terms of the deferred tax, we had to do some calculation. The opening value was provided. No calculation was required here. We only needed to find the temporary differences. The difference between the carrying amount and the tax base was 13 million. However, 3 million related to revaluation, so we deducted that. So we were left with 10 million. We multiplied that to the tax rate. So we were able to calculate the closing deferred tax liability. And when we took the difference of the two, 2.4 million was the deferred tax credit. The credit is deducted here. Okay. So I hope this part is clear. I'm sure no problems with this 16.2 million, this 2.1 million. I told you how to decide whether it's under provision or it's over provision. And we have the final answer. So students, we have done the first one. I have consumed some time because I wanted to explain the whole process. Now, since you know the process, now if you deal with another question relating to the charge to statement of profit and loss, this will be easier. Okay, I will be doing a few more questions so that you understand the concept. Yes, people, I hope you're comfortable. Okay.
Yes, sir.
Okay.
Thank you.
Excellent. Yes, I hope the revaluation part is fine now. Okay. You see, when we are calculating the value for the statement of financial position, we will include the revaluation part. But here we are trying to calculate the charge for the profit and loss. And the revaluation part is an unrealized gain. The value of the asset has increased, but only on paper. We haven't received cash, a higher value of cash as the value has increased. Okay, so we would say that the gain has been realized when we actually sell the asset and get the cash out of it. Okay, so since that hasn't taken place, we have only increased the value in the books. We have debited the asset and credited the revaluation surplus. That's why in the statement of profit and loss, we will only consider the part that is realized. Okay.
Okay.
Yeah, that's correct. So we can proceed with the next one. Okay, I hope we are comfortable with this one. Yes. So let's see what is the next challenge ahead of us. As I told you, we are going to be going through with. Okay, this is a different style question. It's a good one. Let's attack this one. The examiner is going to test you with various questions. Let's see. So this is related to the temporary differences, and then finally, when all the temporary differences are done, we're going to be applying the rate here. So let's see, what is the provision for deferred tax required by IAS 12, income taxes at 31st of December 2028? We know that the deferred tax is the difference between the carrying amount and the tax base multiplied by the tax rate. Okay, let's see the information here. The following information relates to an entity. On 1st of January 2028, the carrying amount of the non-current assets exceeded the tax base, tax written down value by 850,000. So at the start, we can say that the opening temporary differences, the opening temporary differences were 850,000. Okay, so let's see what happened during this year. For the year to 31st of December 2028, the entity claimed depreciation for tax purposes of 500,000 and charged depreciation of 450,000. Now here, the entity claimed depreciation for tax purposes. This is talking about the capital allowances. The capital allowances are more and charge depreciation, the accounting depreciation is less. So clearly, this would further increase the temporary differences, because the tax base is going down by 500, because that is the tax depreciation, which is the capital allowances. So the capital allowances are 500, whereas the accounting depreciation is only 450, which means that the temporary differences are going to further increase by 50. Okay, the tax base is going down by a greater value as compared with the carrying amount. So we can just write it here that the increase due to generous tax depreciation. The tax depreciation is more, so I say generous, because the tax authorities are generous. They give more capital allowances so that the businesses are encouraged to buy more of the non-current assets. Okay, so that is 50. That has actually, or I should add this 50,000 here, because the temporary differences have increased. Okay, because when you charge more tax depreciation and less accounting depreciation, the carrying amount becomes higher, and that leads to further temporary differences. Okay, I hope this point is clear to everyone. Next one. During the year ended 31st of December 2028, the entity revalued a property. The revaluation surplus was 250. Now the revaluation is only considered by the accounting basis, whereas the tax base or the tax authorities do not recognize the revaluation. So clearly, the carrying amount is going to go up by 250,000, and there will be no increase in the tax base. There are no current plans to sell the property. Okay, so which means that the revaluation is going to further increase the temporary differences by 250,000. Okay. So, and finally, they gave us the tax rate, which is 30%. So now we have the sum of the temporary differences, the total temporary differences. Let's find them out and multiply them to the tax rate to calculate the deferred tax. So the answer here is 1.15 million. This is the total temporary differences. Multiply them with the tax rate, multiply that to 30%, and we will have the deferred tax. So let's calculate that value here. This figure multiplied by 0.3. The answer is 3,45,000, which is your deferred tax. Okay. So I hope this is clear. We calculated the temporary differences step by step and calculated the value. Okay. Yeah, because you see, we are trying to calculate the temporary differences. The accounting conventions include the revaluation, whereas the tax authorities do not recognize revaluation. Okay, so that's why when we revalue an asset, the carrying amount increases, whereas the tax base remains unchanged. So due to revaluation, the carrying amount increases, and that results in further increase in temporary differences. I hope this is clear now. Yes, student, I hope the explanation made sense. Okay, excellent. So this is done. This was another slightly different style question. This is how they're going to test you. Okay, so I am now moving on to the next one. Let's see what is the next challenge. So the next challenge is the similar to the first one, where we have to calculate the value of the for the profit and loss. Okay, so let's clear the drawings and then we move on. So here we go. Let's look at the requirement. What is the amount of the income tax charge in the statement of profit or loss of Highwood? So Highwood is the company, and we want to calculate the income tax charge. So remembering the three steps: the under over provision, the charge to the charge for the period, and then the deferred tax adjustment. Okay, so let's see. Let's understand this one. The trial balance of Highwood Co. at 31st of March 2026 showed credit balances of 800,000. So now this is the related to the current account. So Now this is credit balance. The previous question we dealt with, it had a debit balance, and now this one is the credit balance. So whenever you see the credit balance, this refers to over provision. Like last year, we provided more. So this year, this is going to be an adjustment and we're going to reduce it. Last year, we provided 800,000 more. So we're going to deduct this time. And on current end, 2.6 million on deferred tax. So the opening balances on the current tax was 800,000, and for the deferred tax, the opening deferred tax liability was 2.6 million. Okay. So we have the opening deferred tax liability. So let's start with the calculation. We have the over provision. So the over provision of 800,000. This is in millions. So we could just deal with this thing. Let me just do with the. Okay, so this is the over provision. We're going to deduct this 0.8, and then we have this. The next one that we have is the deferred tax. So that is going to be a working. So the deferred tax working. We have the opening liability. The opening liability is 2.6 million. Okay, let's put this with the rounding as well. The figures are rounded, so I have to unround them. So this is 2.6. This is the opening. So moving on with the question, let's see. The property was revalued during the year, giving rise to a deferred tax of 3.75. So the property was revalued and it raised to a deferred tax of 3.75. This has been included in the deferred tax provision of 6.75 at 31st of March 2026. So from the previous question, we see that the deferred tax related to the revaluation is not considered when we're looking at the charge for the statement of profit or loss. So the closing deferred tax liability is 6.75, but it has the 3.75. So we're going to take it away and we're going to calculate the closing deferred tax. Okay. Okay, we've got another. Okay. Yeah, this is not the comparison in this question. Every question is different. Here, they haven't provided us with the temporary differences. They have just provided us with the total deferred tax provision and the deferred tax related to the revaluation. This is a slightly different question. Okay. So let's see. I'm going to have the closing liability. Let's calculate that. So the closing liability, it is 6.75 in total. It has 3 million, that 3.75 that relates to the revaluation. So clearly, we say that the closing deferred tax is 3. So this is an increase. So that means a deferred tax charge, because the deferred tax, the closing deferred tax liability has increased. At the start, it was 2.6 million, but now it has become 3. So this is an increase of 0.4. Okay, so that will be a charge. So we can say the deferred tax charge will be 0.4 here. And finally, we have the easier part, which is the income tax liability for the year ended 31st of March 2026 is estimated to be 19.4 million. So let's add it here. The charge for the year. This is straightforward, no workings needed here. So we're just going to add 19.4 million. And when we take the sum of these figures, we will have the final answer. So that is 19 million. Okay, that is the final answer. That is the charge to the profit or loss. Okay, so this question had the same requirement, but the information was different. And the information was that we were not provided with the temporary differences. We were provided with the closing deferred tax liability, the total, and the one that is related to the revaluation. So we took away the revaluation part. And in the previous question, we were provided with the differences. and we took the difference and then we charged it with the rate. In this question, there is no rate provided. We are simply provided with the deferred tax liability. Okay. So we found out that the deferred tax liability has increased. So that raises a charge. And there was over provision. That was something new in this question. And there was this charge for the year, which is the simplest working, 19.4, which is provided in the question. We simply put it here. So the charge that we're going to take to the income tax is going to be 19 million. Okay, so I hope this one is clear.
Yes, sir.
Okay,
Thank you.
excellent. So let's clear this one and we move on. So we have the next challenge here. Now this is different. We only have to find what charge or credit for deferred taxation should be recorded in astral core statement of profit or loss for the year to 31st of August 20x2. Let's see. We only have to compare the opening deferred tax liability and the closing deferred tax liability, and we have to calculate charge. So like this is a a smaller segment of the previous question, but obviously there will be some different details. So it's a different set question. Let's see. But the important thing that we're looking at charge or credit for the deferred taxation, and we have to have the value for the statement of profit and loss for the year ended 31st of August 20x2. Astral co-purchased an item of plant for 40,000 on 1st of September 20x1. This is at the start of the year, since the year end is 31st of August 20x2. The plant has an estimated useful life of 5 years and an estimated residual value of 5,000. So this is the cost and this is the residual value. The plant is depreciated on a straight line basis. Local tax law does not allow depreciation as an expense, but a tax allowance of 60%. So the tax authorities do not allow the depreciation, whereas the accounting conventions allow the depreciation. So the tax authorities are generous and they offer a 60%, a tax allowance of 60% of the cost of the asset can be claimed in the year of purchase and 20% per annum on a reducing balance basis in the following years. So we do not have to look at the 20% because we're only concerned with the first year, because they want us to find the charge or a credit after 1 year. Okay. So we will be calculating the carrying amount after 1 year and we will be calculating the tax base after 1 year. Okay. So let's see how we can go about this question. And whatever is the difference between the two, where that is going to be the temporary difference, we're going to charge the 30% rate on that. Okay. So let's see. We have this, the opening. We have the, let's say this is the carrying amount and this is the tax base. So we have the cost here. The cost of the asset is the same for both. It is 40,000. And from that, we're going to deduct the less the depreciation. So depreciation for this one, we will have this, the accounting depreciation, which is based on 5-year life and it has a residual value. So what we're going to do is we're going to take this 40,000 less the residual value 5,000. This is 35,000. We take this 35,000 divided by 5 years and we have the depreciation charge as 7,000. So this is the charge for the first year. After that, the carrying amount is 33,000. Whereas when it comes to the tax base, it is 60%. The tax allowance. So the tax allowance is 60%. So we simply take the 60% of this value, that is 24,000. So we deduct the 24,000 and we have the closing tax base. So let's calculate that, which is 16,000. Okay. So now you have the carrying amount as 33 and the tax base is 16. So we can easily calculate the temporary difference here. The temporary difference is 33,000. We take away the tax base of 16,000, which leads us to, that is 17,000. And then we have the, so this is the increase the value, the carrying amount is higher, the tax base is low. So whatever is the temporary difference, we apply the tax rate, and that is going to be the deferred tax charge. Deferred tax charge is going to be 17,000 multiplied by 30% is the tax rate. So we take this value, multiply by 30%. The answer is a tax charge of 5,100. So let's see, we underline this one and we underline this, that it's a tax charge here. So the answer is 5,100 tax charge, the second one. I hope this is clear. It was a slightly different question, but it was a good question that would have helped you understand how we arrive at the carrying amount, how we arrive at the tax base, and then whatever is the difference is the temporary difference. We multiply that to the tax percentage, and we calculate whether it's a deferred tax charge or a credit. Okay.
Yeah.
So
So if it's a positive, it's a charge. If it's a
yes,
minus, it's always
exactly. When the
Yeah.
a credit would be when the deferred tax liability reduces.
Okay. Thank you.
Yes. Okay. Yes. I hope this is clear. So let's move on to the next question, the next challenge that we have. Let me just clear the drawings here. Okay. Okay, so here is another different style question. Let's see what this wants us to deal with. Identify by selecting the options provided below whether a deferred tax asset or a liability should be recognized at 31st of December 20X5 and at what amount. So we have to calculate a deferred tax asset or a liability, whether it's a deferred tax asset or a liability. Clearly, if the carrying amount is higher, we will have a deferred tax liability. If the tax base is higher, we will have a deferred tax asset, and how much will be recognized. Clearly, these figures would be taken to the statement of financial position. So we have this Isaac and Joseph Co. purchased a new machinery on 1st of January 2025, that is at the start of this year, for 1 million. It has a residual value of 200,000. So this is a similar question to the previous one, with useful life of 8 years. The plant depreciated on a straight line basis, and the tax allowances of 50% of the cost can be claimed in the year of purchase, as depreciation is not allowed for tax purposes. So no depreciation, but tax allowance of 50%. Here, the depreciation is based on the 8-year useful life with a residual value of 200,000. So again, we're going to have the carrying amount working and the tax base. So the carrying amount and the tax base. So yeah, I selected these questions in a way so that you could have enough exposure to the similar question that would reinforce the concept. So the cost is 1 million in both the cases. So we copy this here, and then we have the less the depreciation, or we can call it the tax allowance. So the depreciation is going to be it is 1 million. We take away the residual value 200,000, that leaves us with 800,000, and the useful life is also 8 years. So the depreciation is 100,000. Okay, so I could just do this small working for you. This is 1 million less the 200,000, that gives us the value after the residual value, that is 800,000, divided by 8 gives us 100,000. So the depreciation for the first year is 100,000. This leaves us with the carrying amount of 900,000, whereas the tax base is 50%. So the 50%, the 50% allowance. The 50% allowance is 500,000. And then we have the tax base of 500,000 as well. So the difference between the two, we can call it the temporary. The temporary difference would be 400,000 here. Okay, the difference of the two. We multiply that to the tax rate, which is the tax rate is 30%. leads us to the deferred tax liability. So that is straightforward. We simply take the 400,000 multiplied by 30%, that is 120,000. So it's a deferred tax liability, and we just, yeah. So I hope this is clear. It's a deferred tax liability of 120,000. So we have the three options, whether it's an asset or a liability. It's a liability of 120,000. So I hope this is clear.
Yeah, it is.
Okay,
Thank you.
excellent. So I think now it seems to have become easy for you. That's good. So let's just clear the drawings before we move on to the next one. Okay, so here is a really good question. Again, the information, the method is going to be pretty much the same, but the information presented is going to be slightly different. So it's a good one to have further understanding of the under or over provision here. Okay, so let's see. What figures will be shown in the statement of profit or loss for the year ended 30th of September 2021 and the statement of profit and loss as at that date in respect of income tax. So we have this date, and for this date, we have to calculate the figure for the profit and loss in respect of the tax and the figure that goes to the statement of financial position. So let's see, the following information has been extracted from the accounting records of Clearco. The estimated income tax for the year ended 30th of September 20x0. Now remember, we are looking at the year 20x1. So this is the current year. So if we are provided with the estimated figure, this is for the previous year. So the previous year estimate that we provided was 75,000. The income tax that was actually paid was 80,000. So which means that we provided less. So there is an under provision. Okay. We estimated and provided less 75,000. However, the tax that was actually paid was 8,000. So that is under provision of 5,000. This is how you calculate the under or over provision. So we can say that there is this under provision related to this one. Under provision of 80,000. The actual tax was 80,000, whereas we only provided 75,000. So the answer is 5,000. Now we look at what is the estimated income tax for the year ended 30th of September 20x1, which is the current year. This is the tax charge. Tax for the current year. So this is simply added, and we add this thing here. So we have the charge, which is 88,000 for the profit and loss. So we have calculated the profit and loss figure. We have done plenty of question practice. Profit and loss figure is calculated as 88,000. Now, what do we owe to the tax authorities? Because this estimate is only provided so far, it hasn't been paid. So this becomes the liability. Okay, so the liability, for the year ended 30th of September 30th of September X1 is 83,000. So let's 20x1, and that goes to the statement of financial position is the 83,000. So this figure goes to the statement of financial position. Okay, that is SOFP, and this is P&L. So we've got these two answers. We say that the statement of profit and loss is the 88,000 goes here, and the 83,000 goes to the statement of profit and loss. So you come to know that whenever you're dealing with the taxation, the current period's tax, which is unpaid, goes to the statement of financial position as a liability, whereas what goes to the statement of profit and loss is the under or over and the tax charge. And if we were provided with a deferred tax, we would have included that for the profit and loss charge. Okay. So again, a similar concept, but given in a different way. So I hope this is clear as well.
Yes, sir, it's clear.
Excellent, excellent. So I think we can squeeze in another question here before we conclude the session. This is a good one that we can see. We are provided with certain values here because if you look at the requirement, we have to tell whether the amount of the deferred tax is correct or incorrect. We are provided with the calculation of the deferred tax. We are provided with the calculation of revaluation surplus. The question is whether it is correctly done or incorrectly done. We have the information here and we're going to see this. So the information below relates to the financial statements of an entity as at 30th of September 2007. We have the carrying amounts. The carrying amount of the plant is 110,000. The carrying amount of the land is 280,000. Okay, so land has this cost of 200,000, whereas its value is 80,000. The land does not depreciate, so clearly there is a revaluation of 80,000. Okay, so we must say that the revaluation surplus must have 80,000. However, the carrying amount of land is only 110,000. Fine. So these are the carrying amounts. We can calculate the difference of these two, and we will have the total of the carrying amount. When it comes to tax base, the plant has a tax base of 90,000 and the land has a tax base of 200,000, which is equal to the cost, because the tax authorities do not allow the revaluation. Okay, so we have some temporary differences which we're going to calculate here. So this is if we say the temporary difference, the total of carrying amount is provided to us as 110,000 plus the 280,000. So this is the total of the carrying amount. Let's write it here. That is going to be 390,000. We summed up these two, 280 plus 110, and the total of the tax base, which is 90,000 plus the 200,000. So that gives us 290. So clearly there is a temporary difference of 100,000. And we say that the deferred tax is 100,000. That is the temporary difference multiplied by the tax rate, which is 20% in this case. So the tax rate is 20%. So we have a deferred tax of 20,000. Okay. So this figure is correctly calculated here. We have calculated the deferred tax, which is 20,000, and it is also 20,000 here. So we can say that the deferred tax is correctly calculated. Okay. Now comes the revaluation surplus. Okay, I hope you understand. I have calculated the difference between the carrying amount and the tax base. I simply multiplied this to 20%. I got my deferred tax. Moving to the next area, which is the revaluation. So the revaluation surplus has the value of land, which has a cost of only 200,000, and the revalued amount is and revalued amount is to 80,000. So there's a revaluation of 80,000. Okay, so the revaluation surplus, the value of revaluation surplus is 80,000. So we take away that deferred tax here. That's the deferred tax, which is 80,000 into 20%. So that is 80,000 into 20%. That is 16. So we take away the 16,000 and we're left with the updated balance of the revaluation surplus as 64,000. Okay. So let's see if that value is calculated correctly. So they give us the revaluation surplus as 64,000. The revaluation surplus was 280 as a result of the revaluation on land. And when we apply the deferred tax related to that, we are left with 64,000. They've calculated the 64,000. So we can say that both the values have been correctly calculated. Okay. So this was another dimension of understanding. I hope this is clear.
It is clear, sir.
Okay.
Thank you.
You're welcome. So we conclude this second session here with IAS 12. We have planned the third session for the IFRS 16, that is leases. Okay. So we are going to again take a short break of around 10 minutes or so. I hope this is okay before we start the next one. For IFRS 16, you people will also be fresh. You can take up to 15 minutes or 10 minutes is fine.
10 minutes is fine for me.
Okay, that's great. That's great. Fine. Yes, at times, what I would say about Kaplan questions, that Kaplan does not make their own questions. They copy the questions. So in copying, they tend to make it more difficult. But at times they also correct the question. The question becomes a mistake question. That's, you need to remember this about Kaplan. So focus more on ACCA Hub, BPP. These are more reliable. So we take a break here. Students, we have just concluded the IAS 12, and we are going to be looking at the IFRS 16. So let me just save this work for you. Okay, so here we go. We have this. Let's clear the drawings before we move on to the next one. So these questions which I have picked for the IFRS 16 are mainly from the BPP. The questions in BPP are good, challenging questions. So that's why I have picked them. So let's attack them. Let's see how we can figure out this important standard. IFRS 16, another challenging one for students, and another one that is really loved by the examiner. However, once we're done with this, you people will be feeling a lot comfortable and confident. Okay, so let's see what we have here. The requirement is okay, I'm going to highlight the requirement here. What amount will appear under the non-current liabilities in respect of this lease in the statement of financial position of Felony Co. at 31st of December 20x6. Okay, so let's see what is going to be the value that will be reported as the non-current liabilities. So let's see like what will be paid after 1 year. So on 1st of January 20x6, Felony Co. entered into a contract for the right of use to a machine for 4 years period. So this lease is for 4 years. The contract meets the definition of lease under IFRS 16. The important details to underline: the year for which we have to provide, that is 31st of December 20x6, and the start is 1st of January 20x6. The contract meets the definition of a lease, and Felony Co. paid a deposit of 700,000 on the commencement of the lease on 1st of January 20x6. So when the lease started, they had paid the advance payment. On 1st of January 20x6, further 3 installments of 700,000 are payable annually in advance, and the present values of these future lease payments was 1.871.1 million at the commencement of the lease, and the interest rate implicit in the lease is 6%. So what we are going to take, we are going to actually have to calculate the present value of the future lease payments after 1 year. So already during this year, the payment has been made, and the payment that relates to the lease has been made, and we have the present value of the future lease payments as this figure. We are going to apply the interest rate, and we're going to have the closing liability. So this is how we're going to proceed. So let's see let's take this question to the Excel and understand. So this is the typical question, the typical treatment that it requires is common for the leasing question. So let's start a new one for you. Let's clear the drawings first. Okay, here we go. I need to do some settings here. Okay, so we're all set. Let's paste your question here and let's attack this one. So we have the opening or the present value of future lease payments, which is 1,871,100. So this is the value, and we have to apply the implicit rate, the interest rate, at the rate 6%. So simply adding this one here into 0.06, and we add this. We have the closing lease liability after 1 year. So this is the total lease liability after 1 year. We only have to calculate the non-current liability. So whatever is due in 1 year is going to be the current liability, and whatever is due after is the non-current liability. So at the start, they gave us that 3 lease payments have to be made of 700 each, and the present value is 1.871.1. We wrote it. We add the interest rate, and we have the closing lease liability. Now this is the total liability. So what is due in 1 year? So due in 12 months, that is going to be the current liability or the current portion. So that is 700,000 is due to be paid. So we're going to deduct that value, and we will have the balance is going to be the non-current liability. So let's calculate the value, the non-current liability here, the difference of these two. So the amount that will be settled in 1 year time is going to be 1,283,366. So that is your answer. So I first of all calculated the total liability. I took away the portion that has to be settled within 12 months, and I came across what is due after 12 months. So this is the non-current liability that makes it the third option. Okay, so I hope this is clear. This was the case of advance payments. Yes, students, are we comfortable with this one?
It is clear. It's just I just get confused on the non-current part. Let's say we're calculating for the next year.
Yes.
Would have to subtract 700 first. Then
Yes.
I get confused now. Like we're now in the next year, but we have to take out the non-current liability. Could you please explain a bit more?
You see, the thing is that we are done after first year, and at the end of this year, we come to know that what is the total amount that we owe. The total liability that we owe is 1,983,366. This is the total that we have to pay for this lease. Okay, and they tell us that we have to make lease payment of 700,000 this year. So if this is total due, and if this is what is going to be paid this year, so what is going to be the non-current liability? Remember, we are standing at 31st of December 2026, and at this date we are looking at what do we owe in total, that is this figure, and what do we owe in 12 months, and what do we owe after 12 months. So this amount that we owe after 12 months is the non-current liability. This is total, this is current, and this is non-current. And all of this is done at we can say at 31st of December 20x6. This is the date at which we're deciding that. So at this specific date, the total that we owe is this much. Out of that, we break it down to the current portion and the non-current portion. So the question was talking about the non-current, so that's why we calculated what is due after 12 months. Okay.
Yeah. Okay. Sorry. Thank you.
Excellent. Excellent. So moving on to the next one, let me just clear the drawings first. Okay, let's see what is the next challenge ahead of us. Okay, there is one more. Yeah, we will be looking at various questions relating to arrears as well. These are going to come. Okay, there is this another, yes, I hope this one is clear. There is this message from Sheriff. Yes, I hope you're comfortable with this one after I went through it again. Okay, fine. So I hope you're clear. There was a message. So, okay, we have a breather in the form of a theoretical question. Let's see how this goes about. Let's see. Okay, I've got a response. Okay, that's good. So let's see. Identify whether each of the following statements indicates or does not indicate that a contract contains a lease under IFRS 16 leases. So the first one is the lessee obtains substantially all of the economic benefits from use of the asset. So what does this indicate? Well, substantially all of the economic benefits from the use of the asset. This clearly indicates a contract of lease, okay? Because the lessee is going to take all of the, or the substantially all of the benefits, the economic benefits that can be derived from the asset. This clearly indicates lease. The ownership in the asset is transferred at the end of the lease term. At the end of the lease term, the lessee is going to become the owner. That also indicates that it's a lease. Okay. The contract relates to an identified asset, an identified specific asset. Whenever this is the case, that is also related to lease. The last one, if it suits them to do so, the lessor, the one who is giving the asset, can substitute an identical asset. This cannot happen. We cannot substitute an asset because we have this, the contract relates to a specific identified asset. We cannot substitute an asset. So this statement does not indicate a lease, okay? IFRS 16 clearly states that the asset has to be identified and it cannot be substituted, fine? So the first three statements related to a lease, and the last one does not, where we get to have all the benefits related to the asset, we get to have the ownership, and we have this specific asset. Okay, so I hope this is clear. This was some theoretical point that was related to IFRS 16. Okay, so moving on to the next one, hoping that this is understood. So let's clear the drawings and move on. So, okay, there is this next challenge here. Fine. So we have this, the charge. What is the total charge to profit and loss? Okay, so this is, whenever such a question comes, we need to understand what is the sum of the total charge. There are two things. One is the interest, which is implicit in the lease. And the second thing is the depreciation, okay? So always remember, whenever they talk about the charge to profit and loss, it relates to two things, the depreciation charge and the interest. So let's see. Pepworth Co. entered into a contract to acquire the right to use an asset of plant for a period of 3 years. So this is the lease term. And when have they entered? From 1st of April 2007, whereas the year for which we are trying to calculate the charge is after 1 year, that is 31st of March 2008. The contract meets the definition of a lease under IFRS 16. The present value of the future lease payments on commencement of the lease was So this is the present value of the future lease payments, 15462, on which we are going to have the interest, which is also initial carrying amount of right of use of asset. And Pepworth Limited will also make 3 rental payments of 6 million per annum, which are due to be paid in arrears on 31st of March each year. So in this case, this is arrears, and we are going to make these 3 payments. So these are the payments for which we have the this present value. Okay. So the useful life of the plant is deemed to be 5 years. So we take the lesser period, which is the lease term, which is 3 years when it comes to depreciation. And there is no option to buy the asset at the end of the lease term. So we are using a significant portion of this asset. Like out of 5 years, we are having 3 years. And the question has told us that the contract meets the definition of the leases under the IFRS 16. So this point does not confuse you that if we do not get the ownership, it satisfies the requirement of IFRS 16. Fine. The interest rate implicit in the lease is 8%. Okay. So this is straightforward. We are simply going to have the interest at the value of the present value, the present value of the future lease payments, and we're going to calculate a depreciation charge. The sum of these two will be the total charge to profit or loss. So let's get on with it. It seems to be a straightforward one, but it is a question of its own type. We haven't done anything like that. So let's do this one. Okay, so let's paste it here and move on. So we have this one. First of all, we're going to have the interest and then the depreciation charge. So here we go. That is the interest. The main calculation is the charge to. First one is the interest, which is going to be the value of the present value of the future lease payments multiplied by the interest rate implicit in the lease is 8%. So let's calculate that value. 15462 into 0.08. So the answer is this one relates to the interest and the depreciation, straightforward, which is the value, because that is the same value of the right of use asset. So 15462,000 divided by the lease term, which is 3 years. We take 15462,000 divided by 3. That is the depreciation charge. We sum up these values and we have the total charge. So the answer would be D 6390. So that is quite straightforward. Okay. So whenever you're dealing with this question or such a question, you have 2 things that go to the statement of profit or loss. Okay. Okay. Yeah, the useful life is 5 years, but when we're dealing with this thing, we have to take the lower value. Since the lease agreement is for 3 years, so we are going to charge it according to that. Okay. That is the normal useful life of the asset. We haven't taken the asset for its complete useful life, and we will not have the ownership. Fine. So let's see. So this was straightforward. We will be dealing with some more technical questions related to that, where slight adjustments will be done. So I've added those questions. So let's move on with the next one. Let's see what is the next challenge for us. Okay, here we have this small question which helps us understand how do we determine the value of right of use asset. Okay, so at what amount does IFRS 16 leases require a lessee to measure right of use of asset acquired under a lease? So it's quite straightforward. You take the lease liability, you add in any direct cost that you have paid, and you deduct any incentive that you have received. Okay, so this is option A is not correct, and option B is lease liability. You do not deduct the other costs, you add them. So this option is not there. Lease liability plus any direct cost plus amounts paid before or on commencement of the lease. Yeah, that is also part of the calculation of right of use asset. And any incentives that we have received, we deduct it. So this is the appropriate definition of right of use asset. Whatever is the present value of the future lease payments, any direct cost that we have paid, or any amounts that we have paid in advance, okay, before or on commencement of the lease, and any incentive that we have received, we deduct it. Okay, so this is how we compute the value of right of use asset. However, the present value of the future lease payments is only the lease liability. But when it comes to the calculation of right of use asset, we add the other direct cost, we add the any amounts that we have paid before or on commencement, and we deduct any incentive. So this is the right answer. Okay. If you look at the last option, this does not have the direct cost, it deducts it, which is not correct. So this is a very good one to understand which items are included in right of use asset. So concluding this one, we move on to the next one. Okay. So here we go. This is a good question to understand the portion of the current liability and the non-current liability. And one of you asked about the arrears case. So this is the arrears case. The first one, the first question that we did was related to advance payment. So let's see how to decipher this one. What is the carrying amount of the lease current liability? So we will have the total liability, we will have the non-current liability, and we will have the current liability. In FESCO core statement of financial position as at 30th of September 2024. So on 1st of October, so remember that this is after 1 year. On 1st of October 2023, FESCO co acquired the right to use an asset under of plant under a 5-year contract. The contract meets the definition of a lease under IFRS 16 leases. The terms of the contract required an immediate deposit of 2 million. So this is the upfront payment, with 5 payments of 6 million to be paid in arrears commencing on 30th of September 2024. So this is at the end of the first year. We have to make the first payment, and this is in arrears. Okay, after the first year is over. So and the present value of the future lease payments is 22,745 at the commencement of the lease, and the rate of interest implicit in the lease is 10%. So clearly here we have this arrears case, and we have the initial deposit, which we do not consider whenever we are looking at the lease liability. We take the present value of the future lease payments, we apply the rate, and we deduct the lease payment. Okay, so let's see how we go about it. The important thing that we need to do is to distinguish between what is current liability and what is the non-current liability in this case. So let me just clear the drawings for you first. Okay. So here we go. This is the present value of future lease payments. This is at the start, which is 22,745,000, and we have the interest rate at that is 10%. We're going to add that here in 2.1, and we have less the lease payment, which is at the, since this is the case of arrears, so the first payment is going to be made at the end of the year. This is 6 million, and we have the closing or total lease liability. So now we have to distinguish between what is current and what is non-current. So let's calculate the value here. Okay, so we have this value now. So the now what is due in 1 year? Okay, we have to pay 6 million in 1 year. Okay, so there is this easier way and there's another way. So I will just say total due in 1 year is how much? It is 6 million that we have to pay in 1 year time. This is 6 million. However, we are standing at 30th of September 2024, and the next period hasn't come up, and the interest is not going to be due. Okay, so we're going to deduct the interest due in 12 months. We have to make this payment of 6 million, but we cannot consider the interest until the period has elapsed to which the interest relates. So whatever we have to pay, that is 6 million, we take away the interest part from that, the interest that is due in 1 year. So we take the closing lease liability and we apply the 10%, and that is the interest that is due. Okay, so we take this value minus, and we take this value multiplied by 10%. So this is the interest that is due in 1 year time. So this can only be charged if that period has taken place. Since that period has not taken place, we are trying to calculate the current liability portion at 30th of September 2024. And the 30th of September 20x5 hasn't happened. And we're just saying that in total, we owe them, or at the end of the next year, we have to pay 6 million. However, the interest can only be charged if that specific period to which the interest rate has elapsed. So it hasn't elapsed. So clearly, we owe 6 million, we take away the interest portion, and we arrive at the current liability. This is one way of finding the current liability. This might seem difficult to you, so that's why I will be doing the other method as well. We will get the same answer here. I hope this is clear. Or should we deal with the other one? The other one is straightforward. We will just find the current liability for the next year. Okay, so we're just going to follow the way. That is the interest at 10%, which is going to be this value multiplied by 10. And we're going to take away the lease payment, which is going to be 6 million. And we're going to have the closing lease liability at 30th of September x5. So this is the total lease liability. Let's check the value here. Yeah. So that is the total lease liability after 1 year. Okay, so this is the non-current portion. That is, I would say that this is the non-current liability, and this is the total liability. So the difference between the total liability and the non-current liability is the current liability. So we can calculate the current liability as the difference of these two. We take this value, which is 190,19500. We deduct the value of 14921 and the 450. Okay, so I just wanted to do this calculation for you, just to show you. And now I can just take the difference here. This is the total liability, and this is the non-current liability. Clearly, the difference is going to be the same as I calculated here. Okay, I could just put this further down so that you people do not get confused. So this is we get the same answer for the current liability. So I hope you understand. I think this method will suit you more. However, this method is more logical. This one. Either way, you need to get the right answer, and it is B. Fine.
So when you do the calculations for lease liabilities and the interest payments, isn't when you calculate the right of use asset, you deduct any payments made. So when you do this one at the,
This is
do you
not
have to?
this is not right of use of asset. This calculation is not for right of use of asset. This calculation is for the lease liability. Okay.
Okay.
You need to
So you
understand
never
that we're
have
trying to calculate the lease liability. Yes.
So you never have to involve a right of use, like the
Now,
deposit.
the right
those type
of
of
use
things.
asset value is only calculated when we're trying to calculate the depreciation. Okay, because that is the value of the asset that we keep in the statement of financial position. This is the liability part that goes in the liability section. What we owe in terms of for lease in the 12 months and after 12 months. Okay.
Okay, so yes. So thanks.
Yes, I hope this is clear.
Excuse me.
Yes.
Shouldn't be the next year interest current liability?
Obviously, yeah, that is what I recorded here, that the total amount due in the upcoming year is this one, 6 million, but it has the interest portion. Interest is something that relates to a specific period, and it can only be charged if that period has elapsed. So that's why we simply looked at
So
how
shouldn't,
much. Yeah.
excuse me, shouldn't be the carrying amount of the lease liability at the end of the year is the interest?
Yes, this is the lease liability at the end of the year. This is the total liability. Okay, so
Okay.
when it comes to calculating the current liability and the non-current liability, clearly if this is the lease liability at the end of September 2024, this one. So if this is the total liability at the year end, and this is the lease liability after 1 year, so whatever we owe after 1 year is the non-current liability. Okay, and the difference between the total liability and the non-current liability is your current liability. So this is the easier way to understand. So I did both the calculations for you.
No, but they asking for the year of 2004.
Exactly.
So shouldn't
what are they asking? They're asking the current liability. They're not asking about the interest.
the carrying amount of the current liability?
Yes, the current liability part. That is the total liability, and the non-current is this. The difference between the two is the current liability.
Yes.
Okay.
Thank you. Okay, thank you.
You're welcome. So we conclude this one and move on to the next challenge here. Okay, let's see what is the next challenge ahead of us. Okay, so this is a theoretical one. Let's see what challenge they have posed for us. Okay, the objective. Okay, which two of the following are among the criteria set out in IFRS 16 for an arrangement to be classified as a lease? The objective of IFRS 16 leases is to prescribe the appropriate accounting treatment and required disclosure in relation to leases. So the two statements, there are 4 statements we have to see which two are the correct criteria. So the lessee has the right to substantially all of the economic benefits from use of the asset. Now this is true in terms of a lease, that the lessee has right to substantially all of the economic benefits related to the asset. That is fine. The lease term is for substantially all of the estimated useful life of the asset. Now this is not correct. Okay, there is no such thing in IFRS 16 that it is substantially to all of the economic benefits from the asset, not to substantially all of the estimated useful life. This is not the criteria for lease. Okay, so this is, they have really made a good point to confuse you. The third one, the agreement contains an identified asset which cannot be substituted. That is the second correct statement for lease. The fourth one, the lessor has the right to direct the use of asset. Now this is not correct. The lessor has no right. Okay, the lessee has the right. Okay, so this fourth statement is not correct. So the two statements that you're looking for, one is that the lessee has the right to substantially all of the economic benefits from use of the asset, and the other one that this lease agreement is for a specific identifiable asset and it cannot be substituted. It has to be that same asset. Okay. Yes, students, I hope this is clear.
Yes, sir.
Excellent, excellent. So we move on to the next one. Okay, we have this select the total charge to the statement of profit or loss for the year ended 30th of June 20x5 in respect of right of use asset using the options in the pull down list. So this is similar to the question that we have done before, where, as I told you, that whenever there is a question of total charge to profit or loss, it will always be the depreciation and the interest. Okay, so for the year 30th of June 20x5, this has one small addition which we're going to deal with, which the previous question did not have. Previous question was very simple. So Coordinate Co has entered into an agreement for the right to use an asset for a period of 8 years on 1st of July 20x4. That is at the start of the year. The year end is 30th of June 20x5. The useful life of the asset at that date is 10 years. The lease requires annual payments of 750. The useful life of the asset is 10 years. The present value of the future lease on commencement of the lease is 4.657.5 million. The interest rate implicit in the rate is 6%. Additionally, Coordinate Co paid directly attributable cost of 37,500. Now this is the twist here, that we have the present value of the future lease payments and some directly attributable costs. So when it comes to calculating the depreciation, we need to have the value of right to use an asset. So the right to use an asset will have the present value of the future lease payments and the directly attributable cost. So when it comes to calculating the depreciation, we're going to add these two values and we're going to calculate the depreciation based on the useful life. And the interest is going to be based on the present value of the future lease payments. Okay, so this is just a small twist in this question. Otherwise, it's the same. Okay, that this tests your ability to calculate the correct value of the right to use an asset. So let's take this question to the Excel sheet and understand. Okay, so let's see. Fine. Okay, so we have this. First of all, we charge the profit or loss. We have the depreciation charge first, which is going to be the value of the future lease payments, the present value of the future lease payments, 4,657,500 plus the directly attributable cost, 37,500, and whatever value we get, we divide it by the useful life, which is 10 years. So this is how we calculate the depreciation. Now this is slightly different. In the previous question, there was no directly attributable cost. Otherwise, it's the same. So 4,657,500 plus 37,500. So this is the value, and based on this value, we're going to calculate the 10% of this. So that is going to be 469,500. So 469,500 is the depreciation, and now we calculate the interest. The interest is simply based on the present value, future these payments multiplied by 6%. Okay, before I move on, I see I've got some messages. Let me just check. Okay. Yes, let me just check. Okay, yes. Question 104, previous one, because the installment were made in advance, not in arrears. Which one is that? Okay, let me check. What are you suggesting? Which question you want to discuss? The previous one. Yes. Which is the one you are talking about? This is 5-year period. Okay, I'm just looking at the requirement. So here we go. The useful life of the asset is 10 year, and the present value. I think that's about it. Yeah, the period is 8 years. Yes, you're right. We're going to use this 8 years. Yes, thank you for identify. I missed it. So we calculate the value again. So 469. So 500. Okay, let's calculate the value again for the depreciation. That is the lease term. That is 4657. 500 plus the 37,500. That is the value, and we calculated this divided by 8. Yes, that's the value. 586,875. Thank you. So now we've got the right value. Now we have the interest, which is based on the present value. So we take the present value of the future lease payments, 4657,500, multiplied by 6%. So let's have it 4657,500 into 6%. So that is 279,450. We add these two. Okay, got some more messages. Yeah, one thing that we follow the lower of the two, the useful life of the asset or the lease term. In this case, it is 8 years. The second thing that when we are trying to calculate the right of use of asset, we add the directly attributable cost into the present value of future lease payments. That's why I added this one. So that is what I told you, that this is the different part here. Fine. So I hope this is clear now. We just need to sum this up to calculate the total charge. So the total charge in this case is 866,325. That is the answer. We have to calculate, I guess. Yeah. Select the total charge to the statement of profit and loss in respect of right of use asset using the options. Yeah, the total charge would be the depreciation. Okay. So
sorry, sir.
Yes.
So in this case, for this question, we're just gonna put the depreciation charge and not the interest, because I don't understand why are we adding the interest if they're saying in respect of the right of use. That's it.
Yeah, because when we are dealing with a right of use of asset, the lease liability is related to that. So they're not talking about only the charge related to asset. They are talking about the total charge. The right of use of asset is only there because of the lease liability. So the total charge will be your depreciation and your interest related to the lease. Okay.
Okay, sir. Understood.
Okay. So let's move on. So this is the final answer. Okay. So this was a good question. The first one that we did was simple, but here this one had this small twist that we had to deal with. Okay. So going back to the next challenge that we have. Okay. So there are some of the. Okay, another theoretical question. Let's see. What challenge do we have here? A sale and leaseback transaction involves the sale of an asset and the leasing back of the same asset. If the arrangement meets the IFRS 15 revenue from contracts with customers criteria to be recognized as a sale, how should any profit on the sale be treated? Okay, so now here you need to understand the situation of sale and leaseback. Whenever we have a sale and leaseback transaction, we have an asset that has a different total life and we lease it back for a different period. So we will consider that some of the part of the asset has been sold or transferred, and some of the part is kept or retained. Okay, so this needs to be understood. Whenever we are dealing with sale and lease back, we had an asset maybe for a useful life of 10 years, and we have leased it back for 4 years. Okay, I'm just giving you an example. So the portion that relates to sold is the 6 years, and the portion that is kept or retained is 4 years. Okay, so the total life of the asset was 10 years. 4 years we leased it back for 4 years, and that is going to be considered as retained. Okay, so for what portion do we consider the profit? The profit is recognized for the portion that is transferred. Okay, so the question is, criteria to be recognized as a sale, how should any profit on sale be treated? So the profit is always for the portion that has been transferred. So if you look at the options, recognize the whole amount of the profit immediately in the profit. No, we cannot recognize the whole part because we haven't sold the whole asset. We have leased back some of it. Defer profit and amortize over lease time. This makes no sense. Recognize portion relating to the rights of use retained. Again, this is not the thing. This is something that we have retained, we have kept. Recognize portion relating to right of use transferred. Okay, so whatever portion of the asset that we haven't leased back is the one that is transferred. So we are going to consider this part. Whenever we are dealing with sale and lease back, and we have to recognize the profit, we will be considering the profit or recognize the profit that relates to the part that has been transferred. It also makes sense. Okay, this is the theoretical part. We are going to do a question where we are going to do the calculation, and on the basis of the market values, we are going to calculate the right of use that has been transferred. Okay, so this is just the theoretical part, and when you do the numbers, you will be able to understand it better. Okay, so I hope this is clear. Moving on to the next one. Yeah, I just want to move quickly so that we could actually do that question which I'm referring, where you have to calculate the profit. Okay, in between there is this question which is also a good one, and it has various items. Let's see. What amount of the total would be charged to Hyperco statement of profit and loss for the year ended 30th of September 2024? Now the dates are very critical in this question. In respect of the above transaction, enter your answer to the nearest whole dollars. Okay, so what amount of total profit? So this is really the charge to the profit or loss. Okay, so simply we have to have the depreciation, we have to have the interest, and there is one small twist here. Let's see. During the year ended 30th of September 2024, Hyperco entered into the following transactions. On 1st of October 2024, Hyperco entered into a contract to obtain the right to use an asset for a 5-year period. So they entered into this contract, and they entered on the first day of the year because the year ended 30th of September 2024, and the contract meets the definition of the IFRS 16 leases. An initial payment of 90,000 was made on commencement of the lease. Now this payment will be considered for the calculation of right of use asset. Okay, being the first of 5 equal annual payments, the present value of the future lease payments on the commencement of the lease was 2,50,000. So when it comes to the calculation of interest, it will be based on 2,50,000 because this is the present value of the future lease payments. The right of use of asset has a 5-year useful life. The interest rate implicit in the lease has an implicit interest rate of 16%. So we're going to take this present value of the lease payments, we multiply that to 16% to calculate the interest, and then we add these to the future value, the present value of the future lease payments plus the advance payment, and then we divide this by 5 to calculate the depreciation charge. So this is just the old stuff that we have been doing for profit or loss. Okay, the depreciation and the interest. Then comes the small twist here. this is the exception available under IFRS 16 for short lease, which is less than 12 months. So on August, now look at the dates carefully. The year end is 30th of September X4, and this is August 20 X4. So this only counts for 2 months. Hyperco made a payment of 18,000 for a 9-month lease. It's a short lease. So for this, you are exempted for the whole treatment, and you only charge this to the profit or loss of an item of excavation equipment. Hyper wishes to utilize the exceptions available under IFRS 16. This is what I was referring to. So they are going to use the alternate method where they do not have to do the whole calculation, and they simply charge the part to the profit or loss. So this is 18,000 for 9-month period. However, only 2 months relate to the year, August and September X4. Okay, so we have to calculate 3 figures: the depreciation, the interest, and the lease charge for this short lease. Okay, so let's take this question to the Excel sheet and understand. When we do the math, you will have a better understanding. Okay. So not a really difficult or challenging question. It's just that it has some more information which we have to deal with. So we look at this first of all, the interest. The interest is simply the present value of the future lease payments multiplied by the interest rate, which is 16%. So this part is easy, nothing special here. So we take the 250,000 multiplied by 16%. So that is 440,000. And then we have the depreciation. The depreciation is you take the present value of the future lease payments, you add in any payments that you have already made, and you divide it by the 5 years, the life of the asset. So this is 250 plus 90, that sums up to 340,000 divided by 5 years. So this is the depreciation charge. And then you have the short lease, which is payment is 18,000 for 8 months, for 9 months, but we can only consider for 2 months because only 2 months relates to this period. We take the 18,000 into 2 by 9. So that is 4,000. If we sum this figure up, we will have the total charge. So the important thing in this question was dealing with the depreciation by adding the payment into the present value of the future lease payments, and then dividing by 5 years. So I hope this is clear. Not much new in this question. Yes, people, I hope this makes sense.
Yes, sir, it does.
Okay, I just want to do one more question, which is very important here. Okay, yes, there we go. This is important because we have discussed this concept, but we haven't done the question related to it. This is the profit on the portion that we have transferred. Okay, so let's quickly deal with this one. What will be the adjustment required to account for the gain on sale in profit or loss for the year ended 31st of December 2026? So here we have to adjust what will be the adjustment. You need to understand the requirement carefully, that they have already recognized some gain and we have to adjust it because they must have done something wrong. What will be the adjustment required to account for the gain on sale in profit or loss? Okay, so let's see what they have done and what adjustment do we need to do. On 1st of January, that is at the start of the year, Platinum Co sold its head office property, which had a carrying amount of 7 million. So the carrying amount is 7 million to a financial institution for a total of 8 million. So clearly there is a profit of, or a gain of 1 million. Something that was worth 7 million was sold to a financial institution for 8 million. So this is the value that we have, and we calculate the profit as 1 million. The transaction constituted a sale in accordance with IFRS 15, revenue from customers, contracts with customers. The accountant of Platinum Co. recognized the profit of 1 million. So this is where they are wrong, okay? So they have charged all the gain, okay? All the gain as profit. The item had a carrying amount of 7 million. It was sold for 8 million. There is a gain of 1 million, but we can only recognize the profit related to the portion that has been sold or transferred. Okay, so Platinum Co. immediately entered into the agreement for the right to use the head office for a period of 5 years. So here they have there is this total value which is 8 million, and they have entered into the contract for 5 years. Under the terms of the agreement, Platinum must make payments of 600 per annum payable annually in arrears. The present value of the future lease payments is 2162850. So these are the this is the present value of whatever payments we are going to make in future, and the rate implicit in the lease is 12%. Okay, so the total worth of the head office is 8 million. However, we have leased back the portion and it has a value of 2162850. Okay, so the other value relates to the portion that has been transferred. The value that the part of the head office that we have retained has this value, okay, out of this total value of 8 million. So we need to only recognize the gain related to the part that has been transferred. Okay, but we have here Platinum has recognized the total gain of 1 million. This is what is the issue. So now we have to make an adjustment, and we have to deduct the gain related to the part that has been retained, so that automatically the part that has been transferred, the gain related to that should be considered. Okay, so whatever I have said will be clearer when I do the workings for you. Okay, so let's see. It will be easier to grasp. I know your energies might be exhausting by this time, but let's just get done with this one. It's easy. Okay, so let's see. So we have the total value of the property. I will write it in a way that it becomes easy for you to understand. The total value is 8 million, and the value of the head office kept is the present value of the lease payments, which is 2162850. This is the value that has been kept or retained. I should use the word office retained. And the value of the head office transferred is the difference of the two. Okay, the total value is 8 million. We take away the value that has been transferred. So the gain that needs to be recognized should be for this value, gain recognized. So we need to recognize the gain only for this portion. Okay, so what is the total gain? The total gain is 1 billion. We write the total gain as 1 billion, which is we have the item, this head office was worth 8 million. We sold it for 7. We sold it for 8 million. However, the carrying amount was 7 billion. So this is the overall gain. Okay, so let's put it here. This is the gain that is there. So now what we're going to do is anyway, just okay, forget about it. This is the total gain. Now the gain related to part retained, because since they have recognized the whole gain, so now we need to calculate the gain related to the part retained and then adjust it. Okay, so automatically what is left is the portion that relates to the part transferred. So we take the is equal to total gain. How do we calculate it? Total gain multiplied by the part retained divided by total. So the gain is 1 million. The total gain is 1 million. We multiply that to the part retained, which is 21,850, and we divide this by the total, which is 8 million. And we will get the value. So this is related, the gain related to the part retained. Okay, we usually do not recognize it, but in this case, since they have recognized the whole thing, so when we make the adjustment for this one, so automatically the gain that is left, it will be for the part that has been transferred. So let's do the calculation here. So we have this 1 million multiply by 2162,850 divide by. So this is the gain that relates to the part that has been. Okay, let me just. Yeah, this will make more sense now. So we need to make this adjustment. This is the adjustment, okay? They have made the whole thing. They have recognized the whole gain. So when we adjust this part, which is related to the part that has been retained, so automatically what is left is related to the part that has been transferred, okay? So we need to make adjustment for the part retained, adjustment for the gain related to the part retained, so that the balancing figure left is for the part of the gain related to the part transferred. Since they have recognized the whole gain of 1. I hope it makes sense now. Yes, students. Is it clear? Yes, people, are you still with me? Okay, I've got
Yes.
some feedback.
It makes sense. Just maybe on the last part, on the total gain part to be retained.
Yeah.
You
You see the total. Sure. Yeah, the total gain is 1 million. I could just do this working for you. The gain related to part transferred. I could just do this working so that you just have the whole idea. 1 million multiplied by the part that has been transferred, 5,837,150 divided by the total value, which is 8 million. So this is the value which is related to the part that has been transferred. We can just calculate it, or we could just take it total gain 1 million, and we take away this part that is related to transfer. So we automatically have the balancing figure, which is the gain related to the. So this is the gain that should have been recognized, but since they have recognized the whole gain, so we need to make an adjustment for this 273.56. Okay.
Yeah.
Really, we should be making this gain, but since all of the gain, the total 1 million is recognized, so we need to make an adjustment for this one. The question is asking about the adjustment required.
Yeah.
Okay.
Okay. Sense. Yeah.
So students, we conclude the session here. I hope it was fruitful. We have attacked 3 important standards: the IAS 36, the IAS 12, and the IFRS 16. So I hope this was beneficial. We are concluding the session here, and we will be attacking some important standards tomorrow. Okay. So people, that is all from my side. Take good care, and take plenty of rest, and come well prepared tomorrow. I will be sharing the questions as well, okay, in advance. Okay.
Thank you, sir.
Do you use the
See
same
you
link
tomorrow.
tomorrow?
Yes, sir.
You're welcome, people. Take good care.
Thank you.
Do you use the same link
Bye.
tomorrow?
You're welcome.
Good
Bye bye.
night.
Good night.
Sir?